Everybody, morning, Missouri. Good afternoon, 28th of November, 2016. Hope you all had a wonderful Thanksgiving. I'm going to spend a few minutes with you today, and I'll start with the today's market. Then I want to talk about the Fed and the dollar and our prospects going forward. The chart in front of you is a one-year daily chart for the S&P 500. You may recall back in here, I said the market had potentially a couple lines of technical resistance, or a couple areas, if you will. And if we break through it with some momentum, then we've got some blue sky ahead. Technicians can get pretty excited about that. And I drew this trend line, which connected the February low to the Brexit low, and then showed you how that turned into pretty stiff resistance for quite some time. Well, we did break through it, and ironically, with today's 11.6 decline in the S&P, we're falling right on that trend line. So that'll be something to watch. Going forward for you and me, us long-term investors. This is just me helping you put the short-term in perspective, and sometimes it's instructive to take a look at what the technicals are saying. Okay, so but let's get a little deeper and talk about stuff that maybe matters in the intermediate and long-term scheme of things. The Fed is set to raise interest rates next month. And if you believe Fed funds futures trading, there's a 100% probability that they're going to. It makes great sense to me. People are asking me, though, what does that portend? Because they recall in 2015, ironically, in the December meeting, the Fed raised, and we started 2016, the worst start to a year ever. And so here we are again, 1 year later, looking at raising interest rates. And I've shown you recently how the setup is better today, but let's look at it in the context of history. Look at the consolidation box that we've been living in here, and look at the one that we were living in the mid-90s. Very, very similar look. These are very frustrating periods. A lot of unsuspecting investors will make decisions, sometimes get frustrated and give up. And here we are at the tail end of that box, looking at a Fed rate increase that was immediately followed by a precipitous drop in the market. And then this was in the fall, actually November of 1994. And just a few months later, the Fed was geared up to it was 90-something% probability in futures trading that they were going to raise interest rates again. So I'm sure a lot of people were worried. And but look what happened. And this is the next year or so, year plus. The S&P broke out of that box right after that Fed rate increase and achieved a 40% return before it began to show some weakness in 1996. And as you may recall, beyond that, it actually continued to go for a few more years to the upside. So ironically, the Fed rate increase, which I'm sure was viewed with some consternation, I don't know that it created or set the stage for it, but it happened right at a time when the market was ready to break out quite notably to the upside. I have been talking the last couple of years, because the financial media has been talking about it ad nauseum, the relationship or the correlation between the dollar and the market. It has been somewhat negative in recent history. In fact, here is the 2016 back to December 2015 chart, where you can see as the dollar was rising, that's the green line, that's the DXY, the US dollar index. The S&P 500 was falling. There was a period there where they went in the same direction, but here the dollar came down. Here the market rose quite nicely. Then in June, when the market corrected, ironically, it happened while the dollar was rising. In fact, when we go back to the mid-90s, we had a similar look. This is that period that we just looked at. Here's the dollar going down, market going up, dollar going up, market going down, and so forth. So if so much of the narrative we're getting these days is correct, and we should be worried about the higher dollar, I guess we should expect that period, that big 40% increase after we broke out of that box, really should continue here with a lower or a weaker dollar. How else could the market continue to go up unless the dollar was accommodating? Well, didn't quite happen that way. You can see the dollar bottomed right here, and for the remainder, probably 2/3 of that rally, the dollar went up quite nicely, pretty much at the same trajectory as did the S&P 500. In fact, here's the back to modern day. Here is the election, and the dollar's been going up right with the market, or you could say the market's been going up right with the dollar. So I think that we can say with any certainty that the dollar going up is a good or bad thing for the market. It all just depends on timing and what other things are happening out there in the world economy. The moving averages that I've been liking to show you lately, particularly the 200-day, because we're long-term investors, so I'm very interested in the long-term trend, and the 200-day moving average is about as good as any long-term trend indicator there is. And I've told you many times here of late that when it's sloping up, it tends to say good things about the trend, and that's where we are currently. A lot of people like to get a shorter-term view, and they'll fold in the faster 50-day moving average. History suggests that good things happen when the 50-day is above the 200-day, and when they roll over, bad things happen. So you can see there's some support for that here in these two corrections that we had late last year and then that start to this year. Right now, the slope looks good for both moving averages, so that would be positive from a technical perspective. Back in that mid-90s period, similar looking action between the 50 and the 200-day, and sure enough, as we came out of the consolidation box, the slopes were very positive, and then that's pretty much where they lived for the next year and a half, 2 years during that very impressive rally coming out of that long consolidation box to the mid-90s. So what about other periods where we had Fed rate hikes? Again, these can create consternation and worry. It certainly has been for quite some time. Well, here's the mid-2000s. Believe it or not, we had 17 consecutive rate hikes. And this is what the S&P 500 did all along that period before it rolled over to begin that 2008 really rough bear market that we all experienced. So again, here's another look at the market. What I would say, folks, and this has been my experience over the last 32 years, when the Fed is raising rates with the backdrop of a growing, expanding economy, it's not such a bad thing. In fact, what the Fed is trying to do is keep the growth in check so that we don't run away with super high inflation. What about those moving averages during that time period? As you can see, while the market was doing well, and pretty much most of that time period, the 50-day was trading above the 200-day. There's times when it rolls over. You can imagine the problems that if anybody was trading this, you can see that this was mostly, in fact, pretty much the whole time it was volatility to ignore. So this is not actionable stuff we're talking about. This is just kind of things that help me articulate for you what the trend looks like, and you can see the two rolled over. And then in that particular instance, it was volatility to pay attention to because we had that really rough, again, 2008 bear market. What did the dollar do during that whole period? Well, it was kind of a little bit of everything. As the dollar was going down, the market was going up. We could have got excited about that. Then it happened again. But then we had this pretty long stretch here where they were going in the same direction. So again, just more evidence that we shouldn't be as concerned as a lot of people seem to be these days about the relationship between the dollar and the S&P 500. What about breadth? I talked a lot earlier in the year about breadth and how 2016 was looking better. The white line or the mountain chart is the S&P 500 equal weighted index. Every stock in the S&P on this line basically has equal weight. Doesn't matter if you're Amazon.com or Apple or some smaller company, everybody gets the same weight or has the same influence on this line. This line, the green line, is the actual S&P 500 that is cap weighted. So if you're Apple and you move, you're going to have a big influence on the index relative to smaller companies. So it's widely believed that when the more companies are rising with the tide, it actually says better things about the state of the overall market, the state of the economy, etc. And that is the picture. As you can see, there's even a widening gap. So breadth looks good from an equal weighted perspective versus the cap weighted S&P 500. The advanced decline line, cumulative, when more stocks rise on a given day than fall, this line goes up. When more stocks fall than rise, it goes down. We could actually have an up day in the market with this line going down if the up day, like many of the up days in 2015, was concentrated in a few big names. As you can see, the AD line is showing very good breadth, as good a breadth as I've seen since 2013. You can see how it tends to correlate with a better market. Here's the S&P with the same consolidation box. All the S&Ps actually goes back quite a bit further, but you can see we broke out as breadth was breaking out as well. One other indicator I was talking about earlier this year is the number of S&P 500 companies that are trading above their 50-day moving average. The more the better in terms of what it says about the overall market. It was very strong coming off the lows in February, and then it kind of petered out. We had kind of weakening suspect breadth, and it's been looking better of late. And lastly, folks, I have to kind of check myself because as I show you these charts and I tell you about the good setup, I have to bring us back down to earth a little bit and say, folks, we are only talking about probabilities and about how the market looks relative to how it's looked in history. given times when momentum's been in the right direction, when all these things slow. But as we can see time and time again, things tend to change. I could have painted a very optimistic picture right here, and you can see it began to roll over, and it happened fairly quickly, and then we had a rough patch in the market. At the end of the day, we have to contain ourselves and maintain our humility and remember the wise words of a first-century scholar: the only certainty is that nothing is certain, and that is never more true than in the short-term dynamics of the global stock markets. Thank you as always for watching and listening, folks, and I'll be back very soon. Take care.